Good morning, Ms. Knowles.
Okay.
Yeah, I'm not sure what's happening, but I had one person here before and she disappeared. So at the moment, it's just you. I know there are some issues with power in some areas, so I'm not sure. I'll just wait a couple more minutes.
I know if they got the new link for the class. That's probably what it is.
Oh, there's another thing to wear. Okay.
Yeah.
Okay. 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 All right. I guess we will begin. We'll see the other people. Ms. Hill, did you have a power cut just now? I saw where you were out for a bit.
Yes, my current dip.
Yeah, the same thing happened here too. That's what I was wondering. Okay. All right. All right. So good morning again. We are going to begin. I guess when the others get in, they will just catch us wherever we are. Now I sent your test number 3 back to you early this morning, along with those persons who did the makeup. I also sent that back. So with the makeup, we averaged the score you got when you went in face to face, along with what you did with the makeup to form your new average. And if you check your grade sheet, you should see the adjusted score on that. Okay. So, so for today, then, look at that test number 3 at the end of the lesson. But for today, we're going to move on to the chapter that deals with stocks, bonds, and mutual funds. And that's chapter 21 of your text. It starts somewhere around page 504, somewhere there. So before we actually look at the mathematics of the whole thing, I have a short video. Oops, what's going on? That I need to. Okay, let me go back here. Let me see. Yeah, audio. So I'm going to play it. Should take a minute or about less than 3 minutes.
Hi, my name is Sarah Glakis, and I'm with Invest.
I'm just pausing it. Are you able to hear the volume?
Yeah.
Yeah.
Audio? Okay then. All right.
Answers.com. Today, we're going to talk about some pretty important information you need before you start investing, and that is the difference between stocks, bonds, and funds. Let's start with stocks, a word you've probably heard before. A stock is simply an ownership interest in a company. So, if there's a company out there that you've always dreamed of owning, you can go into the stock market, buy one share of stock, and you're an owner. Investing in individual stocks is great for some people, but it tends to be a little bit risky. Stock prices fluctuate from day to day, and they can fluctuate by a lot. So you could buy a stock today for $100, and by tomorrow, for reasons that you might not even understand, the price could go down to $90 or lower. So, if you want to start with something a little safer, bonds may be the answer. Bonds are much safer than stocks because a bond is like an IOU. You're lending a company money, and it's promising to pay you back plus interest. That promise, which is legally binding, makes bonds a lot safer than stocks. But for most people, the most important investment term to understand is funds. If you have only one investment, it will most likely be a fund. A fund is simply a collection of stocks, or a collection of bonds, or even a collection of stocks and bonds together. Instead of buying just one stock or one bond, you can buy a fund that holds a basket of many different stocks, or many different bonds. It's the ultimate in one-stop shopping. There are three main types of funds: index funds, mutual funds, and exchange-traded funds. An index fund tracks an index, like the S&P 500. The index fund simply buys all the stocks that make up the index. For example, an S&P 500 index fund will buy all 500 stocks that are in the S&P 500. If the S&P 500 index goes up, the S&P 500 index fund will go up too. Mutual funds usually try to do even better than an index fund. A mutual fund manager tries to buy stocks that will outperform and sell stocks that will underperform. If the fund manager makes the right choices, your mutual fund will do better than an index fund. But if the fund manager makes the wrong choices, your fund will do worse. That's the risk you take when you buy an actively managed mutual fund. Finally, there are special funds called ETFs, which stands for exchange-traded funds. ETFs are very similar to mutual funds and index funds, but they trade like stocks and they have slightly different tax rules. Ask your tax professional for more information. Thanks for spending time with us at Investing Answers. For more investing definitions, check out our financial.
Okay, so that's it for the video. So it's just a basic introduction. I guess some of you may have more experience with stocks, funds, or bonds. Anybody have dabbled in that world? Any of you too? Having experience with stocks, know what a stock is, what a bond is, what a mutual fund is? Own any?
No.
Miss Knowles? Miss Knowles, are you there?
Pardon? Sorry, repeat that for
Yeah.
me.
I was just asking if you have any experience with dealing with stocks, bonds, or mutual funds.
Oh, no, sir.
Okay. All right. So from that short video, then what do you understand to be the purpose of stocks, bonds, and mutual funds?
I understand that with stocks, you can invest into them.
Okay. So you use the word invest. Okay, that is one of the words I'm looking for. So a stock, in fact, stocks, bonds, and mutual funds are three forms of investment. And of course, the aim of an investment is to make a profit. Nowadays, many banks are not paying any interest. And so many people are looking for other ways to earn from their savings. And so persons are leaning towards or exploring stocks, bonds, mutual funds as a means of investing, saving, making their money work for them. So all three are forms of investment. Now, the fund can be stocks, it can be bonds, or it can be a combination of stocks and bonds. So really, the main two forms of investments we're looking at are stocks and bonds, and funds can contain both. Now, from the short video, what do you notice? What can you remember as a difference between stocks and bonds? What is the difference? One says that you actually own a part of the company, and the other one says you actually giving the company a loan. So you don't own the company, but you're lending some money to the company, and they're supposed to be paying you back with interest. So which one you actually own a part of the company, and which one it is that you're lending the company funds to get back interest on your loan?
Stocks is owning a part of it, and bonds is where you're lending.
Okay, all right. So that's the difference between the two. And then of course the funds could be compile of stocks or bonds or both. Okay, so that's the main difference. So we're going to look a little bit more then. We're going to start off by looking at stocks. Some people use the word shares also. And even though it's not, well, I shouldn't say it's not that popular, but yeah, because there are some persons who, a number of persons who own, a number of banks, in fact, offer their employees the opportunity to buy stocks or shares in the bank. So that's one way you can actually own shares. And if you are part of a credit union, the credit union, the concept of a credit union is one where all the members actually purchase shares. So they own shares. Your monies that you put into the credit union are treated like shares. So at the end of each year, you get a payment, which is called a dividend, okay, as a part of the payout for persons who own shares in, if I want to say, in the credit union. All right, so you see the definitions: a stock, shares of ownership in a company. Now there are two. Well, there's a common stock. Okay, so common stock, it says it allows the owners to have voting rights. So persons who have common stock usually every year, there's what is called an annual general meeting. And at that annual general meeting, or AGM, there is an opportunity to vote to select members for the board, and also to look at some of the policies of the organization. And if they want to make some changes, they will bring it to the shareholders to vote on. Okay, so the common shareholders meet at an AGM each year to exercise their right to vote on a number of positions and issues. Now, they also have what is called preferred stock. Now, the preferred stock says those persons, they do not have voting rights, but they tend to be fewer persons who have preferred stocks. Usually it would be the persons who start the business who would have the preferred stocks, but even though they don't have voting rights, they're given preference in terms of payouts that the company, so if the company makes a profit each year, what they would do, they'll decide how much of the profit they're going to give to the shareholders and how much of the profit they will keep into the company for expansion, for development of the company, and so on. So once they decide how much they're going to pay out to their stockholders, they pay out what is called a dividend. Now, the preferred stockholders or the preferred shareholders, they have first preference for getting dividends, and then anything that's left would go to the common shareholders. Okay, so the trade-off though is that the preferred shareholders, they do not have voting rights. All right, and then the last term here is they refers to cumulative preferred stock, and it says that the owners are entitled to a specific amount of dividends in a year, and we'll look at that a little later on in the lesson. Okay, so I mentioned earlier that each year we have annual general meeting for companies that have shareholders. So at the AGM, the shareholders or the stockholders, they elect the board of directors, and also officers of the corporation are elected. So the common shareholders would have the voting rights to select their board of directors. And usually the dividends are paid out each year. And as I said earlier, it would be payments to the shareholders from the profits. And then you see here in green where it says dividends in arrears. So persons who are cumulative or preferred shareholders, if a company did not pay out dividends, because a company, they don't have to pay dividends, but if they did not pay dividends, the preferred shareholders, they are owed. So if they don't pay out for a particular year, they're going to owe the preferred shareholders for that year. And so if they decide for 3-4 years that they're not going to pay any dividends, they're going to be owing those preferred shareholders for all those years they did not pay. So if in the 5th year they decide to pay dividends, they have to pay what they owe to the preferred shareholders first. And then if anything is left over, then the common shareholders would get a share of the balance, but they are not owed. So the common shareholders are not owed anything. So if the company doesn't pay out for a particular year, then the common shareholders just don't get any dividends for that year. The preferred shareholders don't get any dividends, but they'll be owed for the year, whereas the common shareholders are not owed. All right, so we'll look at some examples a little later in the lesson as to how to work that out. All right, so stocks are traded at stock exchange. Okay. In the Bahamas, we have a very limited stock trading facility. Anybody know what it's called? Ever heard of BISX? BISX? Nobody?
Yes.
Yes. Okay. So that's the Bahamian version of Wall Street, I guess you could call it. All right. So stockbrokers are the persons who would buy and sell stocks. But like I said, it's very limited here. But in more developed countries, it's a more organized and systematic process for buying and trading of stocks. Okay. All right. So moving on now to look at the workings of the stocks. So we have, if you pick up the newspaper and look in the business section, each day you will see stock quotations in a tabular form, and they'll list all the different companies, and they'll give some information about the stock. Now, the layout may be different from what you see here, but much of what you see here would be contained in those tables, those charts. And so we have an example displayed, okay? And so this one we're looking at is for a company called General Mills. So we're just looking at this section right here. Okay, so in the newspaper, you would have several companies listed along with some information about the stock. And so the first thing you see in this table is high. So it says 52 weeks high. Of course, you know that 52 weeks is a year. And so you have high and low. What do you think that high and low refers to? Ms. Roll, are you there? Ms. Roll?
Morning, I'm here. I'm trying to catch up.
Yeah, I'm asking you, looking at that stock quotation, it says 52 weeks high, low. What do you think that means? Today is the 13th of November.
I'm not sure.
You wouldn't take a guess?
I guess it would be the high and low of the stock.
Right. So for 52 weeks, which represents a year, the highest that stock was sold for was $41.06. And the lowest it was sold for was $34.64. Okay, so that's what the high-low refers to. The range of value of the stock over 52 weeks. All right, so people like to know what kind of prices the stock have been selling for. So you might have bought a stock, say, let's say you bought the stock for $20 some years ago, and now you're seeing where it is selling between 41 and 34. So it gives you an idea that the value of the stock is increasing. Now, if you notice that the high and low was starting to decrease, okay, you see high and low 41.06, 34.64, but let's say another year, you see where it drops to maybe $22 and $21, you may decide, you may decide you want to sell because it seems like it's falling, or you may just want to hold on to it longer until the value goes up. So it's a process that the value keeps changing according to what's happening in the market. So people watch those prices to make determinations as to whether they want to sell or just hold on to it a little longer. When the value goes up, some people may sell it because let's say if you bought it for $20 and you see where the high low now range between 41 and 34, you may say, well, if I sell it now, I could get at least $14 profit on what I purchased it for, because the lowest value it was being sold for was $34.64. Okay, so that's your high and low for a year. Okay, so the next section refers to the stock symbol. And basically, it's just the name of the company, abbreviated, and the symbol. So it's General Mills, and the symbol is GIS. Okay. Now, the next is DIV. Ms. Knowles, what do you think that DIV, hold, I spoke. Ms. Knowles, what do you think that DIV stand for?
Dividends.
Dividend. And what are dividends?
Would it be of the portion that the person invested in, but yet.
Okay, right. Thank you. So the dividends for this particular stock is $1.21. So if you have one share, if you only own one share in that company, when they pay out dividends, you'll get $1.21. If you have 100 shares, you'll get 100 times $1.21. If you have 1,000 shares, you'll get 1,000 times $1.21 as your dividends. So your dividends will be multiplied, the dividend will be multiplied by the number of stocks or the number of shares you have in the company, and that will determine your payout. So dividends is the amount you earn as profit or as payout at the end. Well, some companies pay more than once a year, but many just pay once a year, but it can be paid twice a year or even quarterly, which would be 4 times a year. Okay. Now the yield, you'll see this little chart here or formula telling you how the yield is calculated. So the yield, it says, is the annual dividend for the share, which in this case is $1.21, divided by the closing price. And you'll see here where it says close. So the closing price is $39.09. So even though the high and low range from 41.06 to 34.64, today, if you wanted to buy that share, it is being sold for $39.09. That's the closing price. So the close price varies from day to day. And so on this particular day, it was $39.09. So when you divide the $1.21 dividends by the closing price of $39.09, you get 3.1%. And so that is a reflection of what is referred to as the yield. Okay. Now, the next column is what they refer to as and the yield gives you a rough idea of how profitable the stock is. Then we have what is called the PE ratio, the price earning ratio. So the PE ratio, you'll see, it says closing price per share divided by annual earnings per share. Now, in this case, they didn't give us the annual earnings per share in that particular stock. Sometimes they do, depends on, what listing you look at. But you will see that one above actually tells you how to work out the earnings per share. So it's equal to the closing price divided by the PE ratio. Okay, so 39.09 divided by 17 gives you $2.33. So that's the earnings per share. Okay, and then the PE ratio then will be the closing price of the stock divided by the annual earnings per share, which in this case would be 39.09 divided by the 230 that we had up top here, which gives us 17. Now, the next we are looking at is the volume. Now, a lot of students in the past have made mistake with this, and this here says volume in hundreds. So basically, all that means is that you're going to multiply this by 100. So you're going to add 2 zeros to it. Okay. So this 239 should be 239,750,0. So that could be actually 2 million. Hold on, sorry, I have that wrong. 1, 2, 3. How much should be after this 3 here? So that should be 23,975,000. So basically, you just need to add 2 zeros to the end of this because of this hundreds that you see there. So if you want to find how many of those stocks were traded on that particular day, how many were bought and sold, it would add 2 zeros. And so in this case, 23,975,000 shares were sold or purchased. And then the last column tells you the change in value. So it's saying that yet when I look at today's closing price, it's 39.09. It dropped 76 cents from the previous day. So that means if you want to find out what it was the previous day, what would you do to find out what it was yesterday? Today it is 39.09, but the price fell 76 cents. How much was it yesterday? Ms. Hill, you could answer that.
Subtract the 39.09, subtract 76 cents from it.
Okay, so if you subtract 76 cents, what are you going to get?
$38.33.
38.33. So you're saying yesterday it was 38.33 and today it is 39.09. Did the price fall?
If the price fall, yeah, from yesterday's price,
Yes.
the price went up from yesterday's price.
Yeah, so subtracting, so you wouldn't subtract then. Because remember now we say that this net change says minus 76 cents. So that means the price fell by 76 cents. So if you want to find out what the price was yesterday, you wouldn't subtract from the 39.09. What would you do?
So you have to add.
So if you add, what do you get?
39.85.
39.85. So yesterday it was 39.85. Today it is 39.09. So did it fall or increase?
It fell.
Okay, yeah. So basically then when you see a negative net change, if you want to find out what it was the day before, you're going to add that to today's price to find out what it was the day before. And if it was a positive change, then to find out what it was yesterday, you're going to subtract to find out what it was yesterday. All right, so this means it fell, so that means it must have been higher yesterday. And if it says plus, that means it must have been lower yesterday. So you would subtract. All right, so let's look at. Okay, so I'm going to call on you to answer a few of these. So we have A, B, C, then D, E, F, then G, H, I. I have 3 persons. Let me see, 6, yeah, 3 persons. So each of you are going to do 3 parts. So I'm going to start with Miss Roll, A, B, and C. Miss Roll, are you there?
Hi, Mr. Allen. I was here.
Okay, so tell me what A represents.
Okay. It represents the highest that the stock would have been, correct?
Would have sold for 52 weeks. And what does B represent?
The lowest that it would have sold for 52 weeks.
And what does C represent?
With the stock rate.
I didn't hear you.
C would represent the stock that was sold, right?
See, are you looking at the chart?
I'm like, okay.
What do you see at the top where above
stock is, so C would be the stock that was sold.
And then you have two things there. You see good year, and then you see what after the good year.
GT.
What does that GT refer to? What's that? What does the abbreviation SYM mean?
I wasn't here for a lot of, but.
Okay. So SYM is just an abbreviation for symbol.
Okay.
All right. So the stock name is Goodyear, and the symbol for Goodyear is GT.
Okay.
Right. So see, just telling you the name of the company, and the symbol for the company is GT. So the company name is Goodyear. The symbol is GT. So the lowest it was sold for was $23.14. The lowest it sold for was $3.17. And then stock name is Goodyear. Symbol for that company is GT. All right. Thank you, Ms. Roll. Ms. Knowles, the next three. Just tell me what D, E, and F are referring to.
The dividends is the amount that Goodyear paid to the shareholders.
Okay. How much did they pay them this particular time?
0.7 cent.
Well, it wouldn't be 0.7 cents. It would be $0.07, which would be how many cents?
Say it again.
It would be $0.07. So that in cents, that would be what?
70 cents.
No. 0.7 would be 0.7 would be 70 cents, but this is 0.07. That's 0.07. So how much is that in cents?
Cents.
Hmm?
7 cents.
Yes, 7 cents. So they paid out dividends of 7 cents. And then what's the next column?
That's the yield.
And how much is the yield?
The yield is 54 cents.
No, the yield is a percentage.
Wait, that have to be a percentage, sorry.
Okay. So it's 0.54%. All
Yeah.
right, so the yield is not in dollars, it's just a percentage, just to give you an idea of how profitable the stock is. So that's 0.54%. And what's the next column? What does that PE mean?
That means per share, I think.
No. Let's go back and see. PE. Oh, I don't see it here. Let me see. Okay, all right. But it is called the price earning ratio. Okay. I'm looking to see. Okay, they just show the calculation at the bottom here. The closing price over the annual earnings per share. Price earning ratio. Okay, so in this case, the price earning ratio is 16. All right, so we're not doing too much in terms of calculations for these, but we just need to know what the terms refer to. So PE stands for price earning ratio. Okay, next set, we're going to Miss Heald. Tell me what's the next three columns representing.
The first one, G, is volume.
And what would be the volume for this in this case?
The volume would be the 30800 times 100.
Okay, 30800. So when you times it by 100, what are you gonna do?
Add 3 zeros.
3?
3.
How many zeros after the 1
2
and
zeros,
100?
sorry. 2 zeros.
Okay, you're gonna add 2 zeros. So when you put your commas in, then how many stocks were traded that day?
Is that 3,080,000.
Right. Okay. What does H represent?
H represents the closing price.
And what does closing price mean?
that means that that would be the price it was sold for that day.
Right. So that day it was being sold for $13.08. And then the last column is your net change. What does that mean?
That means that the stock increased
It increased by how much?
11 cents.
Okay. So yesterday it was how much? How are we going to find that out?
13.08 subtracted by the 11 cents.
Mm-hmm.
Yesterday it was $12.97.
Right. Thank you. Right. Very good. All right. So that's just a basic look at how we read the stock quotations that will appear in your papers. Of course, depending on which paper you look at, you may see less or more detail, but these are some of the key components of your stock quotation. All right, so in the next slide, we're gonna do some calculations. So I have the three formulas that we looked at earlier, the one for stock yield, the one for earnings per share, and the ones for PE ratio. So the first two questions is looking at, it says calculate the cost omit commission. Now you see commission there. When you buy and sell shares, you have to use a stockbroker most times. And so if you use a stockbroker, you pay them by a commission based on your purchase or sales. But we're not dealing with commission in these examples. So we're just looking at calculate the cost of buying the following shares of stock. So the first one says 400 shares of General Mills at $379.88. The next one, 1,200 shares of Apple at $77.90. What are we going to do to find the answers for those two?
Multiply.
Okay, so multiply each one of those and tell me what you get.
I get $151,952 for the first one.
Okay, so say that again.
$151,952.
Okay. And the second one.
93,480.
Okay. That was Miss Hield.
Yes.
Okay, Miss Knowles, do you get the same answer?
Yeah, so
What about Miss Roll?
Yes, I did.
Okay, all right, thank you. All right, so with those two, all we're doing is to find out how much you pay. So if you want to buy 400 shares of General Mills, and the shares cost $379.88 each, you just multiply the 400 times that, and that tells you how much you have to pay for it. Now, of course, if you're buying through a stockbroker, then you're gonna have to pay the commission, and they usually charge a percentage of your purchase price. You'd have to add that to the amount, but we're not looking at that now. Now, oftentimes if you buy shares directly from the company that's selling the shares, a lot of times when a company is first offering shares for sale, you can buy directly from the company, then you wouldn't have to pay a commission. But then once you want to buy the shares from someone who already owns them, you would probably have to go to a broker to purchase those shares, and then you'd have to pay the broker commission. All right, so we'll look at one or two examples with commission later on in the lesson. The second one, so if you want to buy Apple shares, at that time they were going for $77.90. You decide you want to buy 1,200, you multiply, you get 93,000. And so that would be the amount you'd have to pay for that if you didn't have to pay commission. All right, now the next two, it says calculate the yield of each of the following stocks running to the nearest 10%. And if you look on here, the yield would be this first chart at the bottom. So you divide annual dividend per share by its closing price. So they gave you the annual dividend per share, and they also give you the closing price. So you're going to work out the yield. Now in the next one, 5 and 6, they want you to calculate the earnings per share price earning ratio or stock as needed. So something is missing in 5 and 6. So you're going to use either this here or that to work out what is missing. So I give you about 5 minutes to work on those, and then I'll call on you to answer. Okay, so let's look at that. Those 4, 21.3, 21.3, 21.4, 21.5, and 21.6. I'm gonna step out for a couple minutes, but I'll give you about 5 minutes to deal with those 4. Okay, we should be done with that. Okay, let me hear from Ms. Roll. The first 21.3, what you did? What you got?
For 21.3, I got 1.1.
That should be a percent. So the yearly dividend is 0.68, and you divide that by $64.63. And they say you want it to the nearest tenth. So you should just have 1 point after. 0.68 divided by 6. Okay, you said 1.1%. Okay, 1.1%. Okay, Ms. Knowles, what you got for the Best Buy one?
73%, 0.73.
0.73%. Okay, so that's a small percentage. Okay. All right, Miss nobody else here yet. Okay, so
I have a question.
yes.
Why would it be 7.3 if it's a round to the nearest 10%?
Oh, sorry. Yeah. Sorry, that actually should be 0.7%. Thank you. Yeah. So 7.3 isn't actually wrong, but because the question asks you to go to the nearest tenth, then you should just run it to 0.7%, because you only want it to to the nearest tenth. It should be one decimal place. Okay. All right. The next set one. Okay, Miss Heald. The next one says you need to find the price earning ratio. So what did you get for that?
I got, if I round it, 13.
You said 13?
Yes, if it's a round 12.7. And then if I round it, it would be 13.
Okay, 13. Okay. So round to the nearest whole number would be 13. All right. And then the last one now says you have to find the closing price per share. Earnings per share, okay. So you divide the closing. Okay, anybody got the closing price per share?
I will not be a little confused, so I'm bored.
Okay. Anybody else? Okay, so we have the PE, the price earning ratio was 3.85 equals, oh, sorry. It's 26 for that one equals, we're trying to use information we have, earnings per share is 3.85. Okay, so I'm using this formula at the bottom to see if we could work it out. So the PE ratio, they gave us price earnings ratio is 26. And we know the annual earnings per share is $3.85. So we need to find the closing price per share. So let's call this X. So 26 equals X over 3.85. So how can we find X?
Multiply.
Okay, so we say X over 3.85 equals 26 over 1. So what you're going to multiply? You said multiply, but what are we multiplying?
I multiplied 26 by 3.85.
Okay. So if you cross multiply, which we can do, X would be equal to 26 times 3.85. So X would be equal to
100.1.
100.1.
0.1, and then it says a natural number, so it'll be 100.
Okay. Well, price earning ratio, but for since this is in dollars, you could just put it as $100.10. Let me double check here. 26 times 3.85. $100.10. Okay, so that would be 100.10. Okay. So the PE ratio is the one we'd put it in there as whole number, but this one we'd leave it in dollars and cents. Okay, so now those are some of the basic calculations that we do as far as dealing with stock calculations. Now I want you to look at this here, where we have dividends. This is an example where we have a company that called Jason, and Jason has preferred stock issued of 20,000. The preferred stock is 80 cents per share. So what that means is that all those persons who have preferred stock, they have to be paid 80 cents per share each year. They're owed that. The common stock, they have 400,000 shares. In 2014, Jason paid no dividends. In 2015, they paid dividends of $512,000. So you see the explanation where it says that since Jason declared no dividends in 2014, the company has $16,000, which would be 20,000 times 80 cents. So that's how to get that 16,000. They owe that to the preferred shareholders for 2014. In 2015, they paid out 512,000. And so you see in the table below, they show the division. I want you to look at that closely. Give me 1 second. Okay, though. All right, so the table is broken into two parts. So 2014, you notice nothing is there, 0, 0. Why is that so?
Because he didn't pay any dividends in 2014.
Okay, the company didn't pay any dividends 2014, but you will notice that for the preferred shareholders in 2014, what do you see there? You see some figures there, even though it says paid 0, there's still some figures there. Why are those figures there?
Because they still had preferred, okay, the preferred stock was 20,000 shares.
Okay, so the 20,000, the preferred shareholders or stockholders, they have 20,000 shares, which are at 80 cents per share. So whether the company paid dividends or not, they still owe them. So even though they didn't pay any dividends that year, they still owe those persons for that year. So whenever they pay out dividends again, they are owed that amount of $16,000, which would be the 20,000 times 80 cents. Okay. Now for 2015, you'll see at the very top, it says that they paid out 512,000 based on what the question said. So the first thing they have to do before they do anything else for 2015 is to pay the 16,000 that are owed to the preferred shareholders. So you see at the very top, it says paid for 2014, $16,000, which is the 20,000 times 80 cents. And then for 2015, they still also have to pay them for that year, which is when they paid the dividends. So they owe them for 2014 and 2015. And so altogether, they owe them $32,000 for those 2 years, which you see right here in the pink shaded area. So the total dividends paid out was $512,000. So they paid the preferred shareholders for 2014 and 15, which is $32,000 in total. So they take that $32,000 from the 512. So what's left is $480,000. And so that amount that's left, that goes to the common shareholders or the common stockholders. So altogether, they would get $480,000 for them. And since they have 400,000 shares of common stockholders, then you divide the 480,000 by 400,000. And so each of those shares would be valued at $1.20. So that year, the common stockholders actually got more than the preferred. But because the preferred have to be paid each year, they will be paid for the years that they were owed. Whereas the common stockholders, if nothing was paid, then they're not owed anything. They're only paid out in years when dividends are paid. So depending on how many shares of common stock you have, that will determine how much your check would be. So if you have 50, you multiply 50 times $1.20. If you have 100 times $1.20, and so on. Okay. We follow that procedure. Ms. Roll, do you follow that?
Yes, sir.
Okay. What about Ms. Heald and Ms. Knowles?
Yes.
Okay. Ms. Knowles?
Yes.
Yes. Okay. All right. So I have another one similar here. I want you to look at that. So,
Back to the screen one second. Sorry.
okay.
Thanks.
All right. So I want you to look at this one now. So we have 40,000 preferred stock at 60 cents per share. We have 300,000 shares of common. 2014, nothing was paid. 2015, they paid 210,000. They want you now to say how much is paid to each class of stock in 2015. So I give you a few minutes to figure that out, and then I'll call on you to tell me what you get. Okay, are we done? Miss Knowles, are you done?
No.
No, okay. Miss Roll, you finished?
I'm a bit confused, but I started it.
Okay, tell me what you did so far.
Okay, so,
You're gonna divide up
found
the thing into 2 years. You have 2001 is 14 and 2015, okay?
so the first year, they didn't have a dividend again, but they had the shares of 40,000, so I did 40,000 times the 60%.
Okay. Preferred, you have 40,000 times 60 cents, 0.60, and how much you got?
I got 2,400. So, yeah, that's right.
2,400?
Or 24,000.
24,000. Okay, so the preferred are owed $24,000. So you put owed. Okay, so no dividends, no dividends payout.
No,
Dividends paid out. So the common people wouldn't be owe anything. So right now, even nothing was paid out. I mean, I guess you could put that on top. No dividends paid out. So the preferred are owed 24,000. So in 2015 now, how much was paid out?
2015, they had 210,000.
Okay, so they paid out $210,000. Okay, so the preferred are owed. Preferred, how much are they owed for 2014?
They're owed 24,000.
Okay. For 2014,
And 24,000 for 2015.
24,000. That's 2014. And then for 2015, they're also owed another
24,000.
24,000. So altogether, they're owed
48,000.
$48,000. All right. So what we're going to do with that information?
So this is where I wasn't sure. So I take the 48,000 from the 210.
Okay. So the common shareholders then would get so for common, so you're going to say 210,000 minus the 48,000 gives you how much?
162,000.
Okay, $162,000. So that goes to the common. Okay. So they get a total of $162,000 among the common shareholders. Now, how many common shareholders do they have? Or shares, I should say. How many common shares do they have?
300,000.
300,000. So if you want to work it out, then you would say then 162,000 over the 300,000. So that's going to be equal to how much per share?
54 cents.
54 cents? Okay. 0.54 per share. Okay. All right. So that's how we do that. So 2014, nothing was paid. 2015, they paid 210,000, but they owed 24,000 to the preferred shareholders for 2014. 2015, they have to pay them also for that year. So altogether, they have to take off that 48,000 out of the 210,000, and then whatever is left goes to common stock. So in total, the common stock is 162,000. So since we have 300,000 common stock, we divide that 300,000 into the 162,000, and that tells you how much the dividend is per share. So whatever number of shares the person have, you multiply by 54 cents, and that's how much their check would be, or their amount, their payout would be for that year. Okay, so that's essentially it for the workings of the payout for common and preferred shareholders. Now, another thing that persons want to be able to do when they buy and sell in shares is to work out the return on their investment. Oftentimes you will see it shortened as ROI, return on investment. All right, so you want to know when you buy and sell the shares and you pay out your commission, what kind of profit margin you had. So in this particular example, you are given a situation where this person bought 200 shares and they bought them for $39.09. Then they sold them a year. At the end of 1 year, they sold them for $41.10. Now they have to pay a 1% commission on buying and also a 1% commission on selling. And then they also earn dividends of $1.21 for that period. So you'll see how we have it broken up into bought. So they bought 200 shares at $39.09. So altogether, the cost of that is $7,818. But they have to pay the commission, the stockbroker commission of 1%. So you find 1% of that, which is $78.18. And since you have to pay that to the broker, that's going to be added to the cost of the shares. So that's how they got that $7,896. So the total amount they had to pay was $7,896. Now, when they sold the shares now are now going for $41.10. So 200 times 41.10 gives me $8,220. Now you have to pay the broker 1% again. So you find 1% of the 8,220, you get $82.20. And so you're going to take that out of your selling price. You're selling it for 8,220, but you have to take out the commission for the broker. So when you are selling, you're going to subtract the broker's amount. When you are buying, you're going to add the broker's amount. So when you take out the broker's amount, you're going to be left with $8,137.80. So when you invest in shares, you earn money by the value of the share going up. So this person bought it for $39.09. The value went up to 41. Of course, you can lose too because the value could go down. So you're really taking a risk. But if the value goes up, then that's profit you would make. And then you also earn if dividends are paid. So there are two ways you can earn. The value of the stock go up and the dividends are paid out. So the total receipt then would be what you end up getting from it, which would be this $8,137.80, and what you actually paid to buy it, which would be this $7,896.18. So when you subtract, you got $241.62 was your gain. And then the dividends you earn it was 200 shares and it was $1.21 per share. So that's how they got that 242 that you see right here. And you add the 241 plus the 242. And so in total, your gain was $483.62. And so you put that on top of the amount that you actually paid for the shares, which was the 7896.18. When you work that out as a percentage, you get 6.12%. Okay, so that would be your percentage profit on that investment, your return on investment. You work out how much you bought it for, add your commission, work how much you're going to get when you sell it, subtract your commission, find the difference between those two values to see how much your net gain is. If you get any dividends, you work out your dividends, add it to your net gain, and that will tell you what your total gain is. And then you find that as a percentage of what you actually paid for the shares. Any questions on that? I didn't hear anything, so I guess you're ready to try one. So I have one here. So the setting is already there for you. So I just needed to work out the different sections. So you bought 200 shares of General Electric stock, $18.34. You sold them a year later for $22.10, and you charge a commission of 1% for buying and selling, and you got dividends of $1.24. What was your return on investment? I'll give you a few minutes to work that one out. Oh, Miss Bain is with us. Renee Bain. Hey, Bain. Oh, it's 10:42. All right, let's go through that. Ms. Bain, are you there?
Yes, I am. However, I just signed on, so I was just waiting to catch up to see how we work out these problems.
Okay then, all right. Okay, Ms. Roll, you want to do the first, the bought section?
Okay.
Mhm.
So you want me to tell you how I work it out or just what my answers are?
Yeah, tell me how you work it out, yeah.
Okay, so for the bought shares, it would be the 200 shares times stock at $18.34,
Mm-hmm.
which would be 3,668.
Mm-hmm.
And then the commission at 1%, so that would be 3,668 times the 1%.
Mm-hmm.
And that would be $36.68.
Mm-hmm.
And then the total cost is the the total shares would be 3,668 plus the $36.68.
Mm-hmm.
And that would be $3,704.68.
Okay, thank you. 3,704.68. All right, thank you, Ms. Roll. So that's how much we paid or bought when we put in the commission for those shares, $3,704.68. All right, Ms. Knowles, tell me what you have for the sold portion of it.
200 times the $22.10,
Mhm.
4,420. And then 4,420 times the 1% would give you 4,420
Mhm.
on it.
And then what you gonna do next?
You can give me 1 second because I had to work. Sorry.
Oh, this Miss Knowles?
Yes.
Oh, okay,
Sorry.
okay, okay. Ms. Hale, what you have for the final answer for that section?
The total cost that I have is 4,375.80.
Okay, and then I want you to do the next portion now, the total receipts. Miss
Okay,
P?
so for total receipt, I have the 4,375.80 subtracted by the 3,704.68, which
Mm-hmm.
gave me a total of $671.12.
Mm-hmm.
And then for the dividends, I multiplied the 200 by the $1.24. And that gave me 248.
Mm-hmm.
I add the 671.12 and the 248 together, and that gave me $919.12.
Okay. And then your returning investment?
For my returning investment, I divided the $919.12 by the 3,704.68. And then multiply it by, I got 0.248. Let's just stop there. Then I multiply it by 100. and I got 24.81 by round.
Okay, 24.81% to the nearest hundredth. All right, thank you much. So that was a very good return on investment at 24%. Okay, so depending on how the value of the shares increase, along with the dividends that are paid out, that will determine what kind of percentage you get on your investment. Okay, so all right, so that basically finishes off the section on shares, on stocks. All right, so we're gonna spend a little bit more time now looking at the bonds and mutual funds. Now, the shares, we said you actually have ownership in the company, you have voting rights and so on. With the bonds, it's different. So I have some notes here from your textbook, page 514. And Ms. Bain, since you weren't here, I'm going to ask you to read that first section, just to where you see the dotted line.
Okay, so it says, sometimes companies raise money by selling bonds instead of stocks. When you buy stock, you become a part owner in the company. To raise money, companies may not want to sell more stocks and thus dilute the ownership of their current stock owners. So they sell bonds. Bonds represent a promise from the company to pay the face amount to the bond owner at a future date, along with interest payments at a stated rate. Once a company issues bonds, they are traded as stock is. If a company goes bankrupt, bondholders have the first claim to assess
To the asset.
the first claim to the assets of the corporation before stockholders. As with stocks, changes in bond prices vary according to supply and demand. Brokers also change commissions on bond trading. Charge. Brokers also charge commission on bond trading. These commissions vary.
Okay, so what you understand from that? Number one, what's the difference between bonds and shares, for example, and stocks?
The difference between bond and stock?
Yeah, one of them is like a loan and one of them is ownership.
Right.
Which one? Which is which?
The bond, the shares is like ownership and bonds is like stock.
Okay, so, all right. So the shares, you actually own a part of the company, and with the bonds, you are actually lending the company funds, or persons are buying, lending the company monies, and the company would pay them an interest, okay, as well as the value of the bonds may go up or down depending on the market, okay? So you basically do not own the company, but you are lending to the company with the expectation that you will get interest on your loan, and the value of the bond may go up. Now, there's another interesting thing about bonds, which is one advantage a bond have, and that has to do with if the company fails. What does it say about what happens if a company goes bankrupt as it relates to bonds compared to shares. Who has first claim?
Bondholders.
The bondholders have first claim. So because you are owner of a company, if you are owner of a company, if you own shares, if the company goes bankrupt, that's partly your responsibility. So you have to suffer the loss. But the persons who lend you money, they have first choice in terms of making claims to whatever assets the company have. So that's one advantage of owning stocks. I mean bonds over stocks. Okay. And it also says that the bonds are traded the same way as stocks are traded. So you can go on the stock market and buy bonds and sell bonds. And in the same way we did the calculations just now where we work out the return on investment for the stocks, you could do same thing with bonds. Look at how much you bought it for, how much you sold it for, and how much interest you earned on it. And you can calculate your return on investments. Now, the bond setup is a little different in terms of what appears in the newspaper. So that next section will speak a little bit about that. So Miss Roll, are you there with us? Who is at work? Is it Miss Roll at work? I can't remember.
No, I'm here.
Okay, so you want to read that second section for me, please?
Okay. The bond section of the newspaper shows the bonds that are traded that day. The information given on bonds differ from the information given on stocks. The newspaper states bond prices in percents of face amount, not in dollar amounts, as stock prices are stated. Also, bonds are usually in denominations of 1,000, the face amount. When a bond sells at a price below, when a bond sells at a price below its face value, the bond is sold at a discount. Why? The interest that the bond pays may not be as high as the current market rate. When this happens, the bond is not as attractive to investors and it sells for a discount. The opposite could of course also occur. The bond may sell at a premium, which means that the bond sells for more than its face value, or the bond interest is higher than the current market rate.
Okay, thank you. All right, so one thing to note with stocks, the value is stated in terms of how much dollars and cents the stock is valued at. With bonds, it is given as a percentage, okay? And the face amount is usually in denominations of $1,000. And so we'll look at that shortly when we look at one or two examples. The bond also may sell above or below the stated price. If it's sell below, it's at a discount. If it's above, then it's at a premium. Okay, so discount and premium simply refers to whether or not the bond is going above market value or below market value. So let's look at this example appears on page 514 to 515 of your book. So they give you a bond quotation. Oops, I try to put a line here to show a separation, which the book didn't do. But this bond is for a company called Aflac. And where I put that separation line, it should be 4 and there should be a space and then 2, 2. But they had the 2 joined together. So the bond company is Aflac. The 4 is the interest rate. The 22 is supposed to represent the year that the bond matures. The yield is 4.02%. The volume for that day is 214,500 87. It doesn't say add any zeros to it. And the close is 99.5, and that's a percent, 99.50%. And the change is -1, and that's a percent also. So you'll see in the description, it says the name of the company is Aflac. It produces a wide range of insurance coverage. Of course, I guess if you watch TV, you'll hear about Aflac on a lot of ads. The interest rate on the bond is 4%. So that first 4 right after the Aflac name represents the interest rate, 4%. The company pays interest semi-annually. Now, we're not, well, unless it says so, we wouldn't know from the quotation. It doesn't say how often it's paid, but we know for sure annually. But in this case, they're saying it pays semi-annually. The bond matures or comes due in 2022. So the number after the 4 tells you when the bond matures. The total interest for the year, because it's 4% and the unit value is a denomination of $1,000, you find 4% of 1,000. So 4% of 1,000 would be $40. So they would get $40 per year interest on this bond. And it says, remember the face value of the bond is $1,000. Now let's show the formula. And so they put the yearly interest equal face value of bond, which is 1,000, times the interest rate, which is 4%. So 4% of 1,000 is $40. And so if you're asked to work out the interest rate or the amount of interest earned, you would find 4% of 1,000 because the stated rate is 4%. Okay. Now the yield, it says, is equal to the yearly interest over the closing price of the bond. So the yearly interest in this case is, we worked it out to be $40, and the closing price of the bond. Now the bond here says the close is 99.5. That means 99.5%. Okay. So if you find 99.5% of 1,000, if you look at the bottom here, they show the calculation. 0.995 times 1,000 gives you $995. So even though the face value of the bond is $1,000, the closing price that day was 99.5%, which is $995, which means that this bond is going at a discount because it's less than 1,000. The value, the face value is 1,000, but it is being sold for $995. So it is being sold at a discount. All right. So $40 over the $995 works out to 4.02%, which is what the current yield is. Okay. So even though it's going at a discount, because of the fact that you're getting 4% interest, you still earn interest, in this case, a yield of 4.02%. All right, they say on this day, 200 and, I don't know why they put a dollar sign here. On this day, 214,587 bonds were traded. I don't think there should be a dollar sign here. That just tells you how many bonds were traded. Note that we do not add zeros as we did the sales volume of stock. Now, the adding of zeros, it depends on the stock that you're looking at. It's just that in this book, they put the zeros there, but not every quotation have those zeros. And in this case, with the bonds, there are no zeros. So you simply just write what you see. If I ask you for the volume, it'll be 214,587. And there shouldn't be a dollar sign because it's just telling you how many of the stocks were traded. So it's just the amount, not the dollars, not how much money, just how many of those bonds were traded. Now, the last bond traded on this day was 99.50, which is the face value, which works out to, now again, another mistake here. They put 0.99. It should be $995. I put it in green because when you multiply 99.5% of 1,000, you get $995. So the book had an error at this point also. I don't know if they corrected it in later editions, but that's what they have in the edition I have. Okay, so the last trade of the day was down 1%. So you see the net change, -1. That means it went down 1%. So 1% of 1,000 is $10. So that means it went down $10. So that means the day before it was $10 more. So we said it was $9.95. So the day before it would have been 1,005, because when you add $10 to $9.95, you get 1,005. So yesterday's would have been 1,005. Okay, so note that with the bond, we're looking at face value for $1,000, and basically most of these numbers that you see here, the rate, the yield, the close, and the change, all of those are percentages. Okay, so you see at the bottom here, it says note bond prices are stated as a percent of the face amount. So the close is a percentage of 1,000. The net change is a percentage of 1,000. The interest is a percentage. Okay, so let's move to this next slide. We're going to look at a few calculations with bonds. So the first one says, for each of these bonds, calculate the total dollar amount you would pay at the quoted price. So we're not looking at commission, we're just looking at the price. Look at the first one. It says petrol, the bond price is 87.75. You purchase 3 bonds. What is the dollar amount of the purchase price? So remember, this 87.75 is representing a percentage of 1,000. So what is 87.75% of 1,000?
$877.50.
Okay, so you'd say 0.8775 times 1,000, and that gives you 1, 2, 3. Oh, sorry, that's not the answer we want. So the answer is going to be equal to $877.50. But we purchased 3 of the bonds. So what would be the cost of 3 bonds if one bond is $877.50?
$2,632.50.
$2,632.50.
50 cents.
Okay. Okay, look at the next one. The bond, so this one is going at a discount because it's lower than 100%. Now this one is at a premium because it's over 100%. So tell me what the cost of one of these bonds would be if it's 114% is the close price.
1,140.
1,140.
140.
Okay, so it'd be 1.14 times 1,000. So it'd be $1,140. And we're buying 2 of those bonds. So how much are we going to pay for 2 of those bonds?
$2,280.
$2,280. Okay, thank you. All right. Now, next one, they say for the following bonds, calculate the total annual interest, the total cost, and the current yield. So this here is the first one. 2212. You see the company name, the bond name is Sharn. The interest rate is 11.75%. The year of maturity is 2012, the number of bonds purchased is 2, the selling price is 115%. So the first thing they want is the annual interest. So what is the interest rate for this one? What is the rate of interest? The rate of interest, you don't have to do any calculations for it. It's right, it's stated right there. What's the interest rate?
It'll be 11.75.
11.75%. Okay. So if it's 11.75%, how will we find the annual interest for that particular one? What's the face value of one bond again?
150.
What's the face value of one bond? The bonds are in multiples of what?
Or 2.
No, not 2. Remember, we say bonds are in denominations of what?
1,000.
1,000.
Okay. So in this case, we have a bond here where the interest rate is 11.75%. So I'm saying to you now, in a case like that, how much interest would you be earning from a bond where the interest rate is 11.75%? How are you going to find that?
1,000 times 11.5.
Okay, 11.75. When you change that to a decimal, you get 0. What? 11.75 as a decimal is what? 11.75%.
0.1175.
Okay, so when you multiply that by 1,000, you're going to get
$117.50.
okay, $117.50. So if you only had one of those bonds, your interest would be $117.50, but you purchased 2 bonds. So total annual interest for 2 would be
$235.
okay, would be $235. All right. So because we have dealing with 2 bonds, we'll get 2 times the $117.50 to give us $235. Now the selling price of this bond is 115%. Okay, so that's what you're going to use to work out the cost of the bond. The bond is being sold at 115%, and it's 2 of them. So let's find out what one would cost. How would we find that out? What's the face value of one bond again?
1,000 times 1.15.
Okay, it's going to be 1,000 times 1.15 because you're changing that 115% to a decimal. So when you multiply that, you're going to get 1,150. So one bond is being sold for 1,150. So if you're dealing with 2 bonds, it would be
2,300.
$2,300. 2,300. Okay. And now they want you to state the yield. The yield will be the interest over the cost. So if you want to find the yield, your 2 years interest is 235, and your 2 years total cost, sorry, not 2 years, your 2 bonds, total cost is 2,300. So what would be the yield? as a percentage?
That'll be 10,
Hmm?
It'd be
that's 30.
10.
10.22,
Well, they wanted the nearest 10%, so just one decimal place, 10.2%.
10.2.
Okay, 235 divided by 2,300. You say give you 10.2. Okay. Okay, 10.2%. All right, I want you to do the next one. So we have Wang. The interest rate is 6.5%. It matures in 2014. They are purchasing 4 bonds. The selling price is 68.125%. So you're going to work out the interest for one first, then for the 4, you're going to put the interest rate for 4 here. But you have to find 1 first. Then you're going to work out the total cost for 1 and then work it out for 4, and then find the yield. I'll give you a few minutes to do that before we move on. Okay, Miss Bain.
Hi.
Okay, tell me what you did for the first part.
Okay, so I converted 6.5 into a decimal, which is 0.065.
Mm-hmm.
I multiplied it by 1,000.
Mm-hmm.
That gave me 65.
Mm-hmm.
Then I did 65. Sorry, that gave me 65. And because it's the number of bonds is 4, it's 65 times 4, and that gave me 260.
So what your total was, you said?
260.
Okay, 260. Right, thank you. All right. So we have a rate here, interest rate of 6.5%. So you'd multiply 6.5% times 1,000, which would be 0.065 times 1,000, which gives you $65 for one bond. But because we're dealing with 4 bonds, we multiply that 65 by 4 to get a total annual interest of $260. All right. So now the next part, Miss Roll, are you there? You can tell me now what you got for the total cost. How are you going to work that out? First, you have to find the cost of one.
So for the total cost, I did the times of the bond, 1,000 times 0.68125. And I got 681.25 for one bond. So the total cost would be $2,725.
Okay. Okay, that's 2,725 for the 4. By the way, is that bond going at a discount or a premium? Miss Roll?
Pardon me?
Is that bond going at a discount or a premium?
It's going at a premium. Let me just double check.
What's the face value for the bond again?
1,000, so it's going at a premium.
And what is the selling price of the bond that you worked out for one bond?
The selling price is $681.25.
Right. So is that a premium or a discount?
That's a discount.
Discount, because it's being sold for less than the face value. Right. So that's a discount. Okay. Thank you, Ms. Rowe. All right. So now we need to work out the current yield. So Ms. Heald, how did you work out the current yield? Hold on, Ms. Knowles is the one at work. And Ms. Knowles, are you there? Atia Knowles? Oh, Ms. Knowles, you available? All right, so let me go back to Ms. Heald. Tell me how you worked out the
216 divided by 2,725. I times the total 0.0954 times 100, and I got 9.5.
9.5%, because they wanted to the nearest tenth, so you got 9.5%. Okay, so that would be your yield, current yield. Okay, so at the bottom of that screen, you see a bond stated in the format that may appear in a newspaper. So the name of the company is Aetna. What does that 7.5 represent? Anybody want to tell us what does the 7.5 represent in that bond quotation? I have to call a name in. Branique, what does the 7.5 represent? Ms. Bain? What does the 7.5 represent?
The percent
The percent of what?
of the face value of the bond.
But okay, but what purpose does that 7.5 serve? What does it inform you about? How does it help you with the bond? Ms. Roll, can you tell us? I know it's a percent, but what does that represent? Ms. Roll, are you there?
I'm here.
Yeah. The 7.5 right after the Aetna. What is that telling us?
I'm
Yeah,
not sure.
You're not sure. You don't even want to take a guess? Sometimes the guess is good, you know. How will we use that 7.5? What is it? What does it help us to do?
It helps us to find our bond price. No,
To find what?
the bond price.
No, the bond price would be the close. Now, when we buy and sell bonds, it's two things we're going to profit from. We're going to profit from earning interest, and we're going to profit from the bond price going up. So it's two numbers that we really need to help us to when we're dealing with bonds. How much interest I'm going to earn and how much I'm going to earn if I sell the bond. So we want the price to go up from what we bought it for, so we could sell it for a higher price than what we bought it. So which figure on that statement was going to help us to work out the interest you're going to earn for that bond?
Oh, so the 7.5 is when we're trying to figure out if it's gonna be if we're gonna sell or not sell or buy, if it's gonna be a loss or
Not really. Remember now, it's two things we're looking for. We're looking for how much interest I'm going to earn from this, or how much I'm going to be able to sell it for. We already said the close is how much you're going to sell it for. What is the close for this one?
125 cents.
100.25%. Remember now with bond, it's in percent. So it would be at 100.25% of 1,000 would be the close. So when you multiply 1,000 times that would give you, that's at $1,002.50. But that's 7.5 right next to the name, the Aetna name, is telling us now what? Mr. Heel, can you help us?
Hi.
Yeah, that's 7.5 right next to the name of the company, the name of the bond. What is that telling us? Ms. Hill?
I'm guessing. I'm going to take a guess and say that it would tell us how much.
We just did some calculations using that. Look at number 21,313 and 21,12. The number that came right after the company, the name of the bond, the 6.5%, the 11.75%. What are those telling us?
Is it how much we would earn?
How much you earn in terms of?
How much you would earn in terms of the, hold on, I can't remember the PE, some per something price earning for the year.
No. I feel bad, like I didn't teach y'all anything.
It's just a lot. It's kind of confusing.
Because that right after the company name. Okay, look at I go back to the slide, and it says AFLAC, and then you see the 4, and what it says, you see that? I just underline. What I just underline, what it says.
Oh, the interest?
Interest on the bond.
Yes. So that first number right here after the company name tells you what the interest on the bond is, how much interest that bond is going to pay. Okay, so if I ask you how much interest this bond is going to pay, it's going to be 7.5% of $1,000. So if I buy 3 of those bonds, once you find 7.5% of that, you're going to multiply by 3 to find out how much you're going to get in total for interest. But if I only buy 1 of the bond, you'll find 7.5% of 1,000, and that will tell you how much interest you're going to earn. What does this 14 represent?
Is that the time frame, the amount of years?
The year that the bond will mature. So what year will this bond mature? Or was it supposed to have matured?
2014.
To 2014. Of course, this is an old book we're using, so that was 2014 that it should have matured. Okay, the yield would be when we have a division to do to work out the yield. The sales have to do with how many of those bonds were sold that day. The close, what does the close help us to do? What do we mean by close? The
At
close is,
maturity?
no, the close is something that happens each day.
The price, the closing price, 44
Price.
for 3.
Right, the closing price of the bond. So each day, and when you look in the papers, you will see all these shares and bonds. They'll tell you what the closing price is for that day. But because we are dealing with bonds here, they don't tell you the dollar amount, they tell it to you as a percentage. Now, I don't know, some papers, some companies may actually give it as dollar amount, but for this book, we are sticking to a percentage. So it's given you as a percentage. So it's a percentage of 1,000. So the closing for this bond is 100.25% of 1,000. So if you find 100.25% of 1,000, that will tell you how much that bond is being sold for today at the end of the day. And then the net change, what does net change mean? What does the change mean? Anybody? What do you mean by change? Everybody should know that. Change, we're changing. What happens? In this case, it's plus 0.75. What does that mean?
That's how much it goes by.
Okay, so it increased. So today, the price went up. When you see a negative, it means the price went down. When you see a positive, it means the price went up. So there was a change in price of 0.75% for that bond on this particular day. Okay, so we're going to finish off with our look at bonds, and we're just going to spend a couple minutes looking quickly at mutual funds. All right, so with the mutual funds, we said, if you remember the little video clip we did at the beginning, it is a combination of shares or a combination of bonds or a combination of shares and bonds. So it's not just one bond or one company that we're looking at. We're looking at a combination because we want to diversify and increase our chance of making a profit. If you just buy stocks or bonds in one company, your risk of loss is much greater than if you buy in multiple companies. And so that's one of the advantages of using mutual funds, because you have a better chance of making a profit because you're not just buying one stock or one bond, you're buying groups, multiple. The thing with the mutual funds too is that it's usually managed by professionals. Okay, so it's not something that you could just say you're going to create a mutual fund. That you'd have to purchase from a professional management company. The mutual funds tend to be easier to convert to cash. And according to the information from your text, it says that the expenses are lower than when you're dealing with bonds and stocks. Now, access to foreign markets, that would of course be more from outside the Bahamas, because in the central bank here kind of restrict our ability to engage in mutual funds overseas in order to control the value of the dollar. But there are one or two companies that do offer local mutual funds, but I don't think you're able to access foreign markets at this time because of the effort to manage the value of the Bahamian dollar. Okay, so with mutual funds, we don't have much calculations per se. We just need to be aware of one or two things with the mutual fund, that the mutual fund is a combination, a portfolio of stocks and or bonds, okay? And one of the key things to know about the mutual fund is what the net asset value is. That's the dollar value of one mutual fund share. So you might have multiple, but we tend to look for that net asset value, and they have the formula here. Like I said, we're not going to actually do any calculations with that, but you just need to know that basically it is a current market value of the fund's investment minus liabilities over number of shares outstanding. Like I said, we're not doing any calculations. That's just an idea of the definition. Then they're looking at our commission charges. Now, of course, some of this wouldn't be applied locally, but definitely in the papers, you may see mutual fund quotations. They're not as involved as the stock or the bonds. So first column usually have the name, then the net asset value. So in this case, one of the net asset, one of the fund, this value is $9.72. This is telling you what the change in value is. The change, well, because there's no sign, you can assume it to be positive. So it increased by 24 cents. And then this represents the year-to-date percentage return. So it's something similar to the yield. So you get 4.1% year-to-date return. So you just need to know what is in each column for the mutual funds. So we're going to look at an example here. So because the mutual fund is combined of several stocks and or bonds, they tend to be in these groups. So you'll see here, it's not going to be just one. It's going, in this case, it's a whole group of different funds. So it says here the name of the fund. If you look at the top, this is the group Putnam Funds. That's the name of the mutual fund. And then within that, you have several. So it says that the name of the fund is Growth and Income. So they highlighted a section here and it's abbreviated. So it says Growth and Income, but it's abbreviated GRIN, GR for growth, IN for income. All right. And so the first column tells you the net asset value, which is $13.82. Okay. The next column tells you the change. So you see the change is negative 0.06. That means the value went down 6 cents. Okay. So that's why it's negative 0. That means yesterday it was higher. It was 6 cents higher. And then this 8.9, it says the fund has a return of 8.9% this year from January through, in this case, it was May sometime. All right, so that's just telling you what the return on the fund is. So basically, that's all we need to be able to do with the mutual fund, just to know. First column is your net asset value. The second column is your indicating of the change, and then your return from the beginning of the year, what the return on the investment is. So people are looking to see increased returns so that they can earn more profitably from the investment. All right, so let's look at this last question before we close. And so in this one, you are given, this one says, from the mutual fund quotation of Schwab Healthcare Growth Fund shown below, complete the following. So the whole group is called Schwab Funds, but we're looking for the Healthcare Growth Fund. So healthcare, if you go down the line, you'll see this one here that says HLTHCARE. So that's the one we're looking for. And if you go across, we'll see, remember the first column is NAV. Next column is the change. And the next column is the year-to-date return. All right, so what's the net asset value for this particular one, the Healthcare Growth Fund? Ms. Bain, tell me what you see there.
I see 1833.
$18.33, okay. So the net asset, that means one unit of that mutual fund is being sold for $18.33. Okay, Miss Roll, what is the net asset value change?
Um, 4.4.
No, the second column.
Second.
The first column is 1833,
Oh, okay.
which is
I keep that. Sorry. Is it in our box? Because it's kind of small.
oh, let me see if I could.
Okay, so it'll be negative 0.11.
Okay, so that's minus 11 cents. So that's negative 0.11. So that means that the value of that went down 11 cents compared to the previous day. And then Ms. Hill, what is the total return year to date?
4.4.
4.4%. So the return on that is 4.4%. So we're not concerned about this last column. So we're just looking at net asset value, the change in the value, and the return year to date. Okay. All right. So your homework questions are here. Hold on. Did I? Oh yeah. So the questions, I have them copied onto the thing. So you can see I have the ones that you're supposed to do circled. So it's question 1, 2, 3, 4, 5, 6, 1, 2, 3, 4, 6, and 9. So one have all these parts, then 2, 3, 4. What's going on here? Okay, 1, 2, okay, 6 and 9. And then just 1 and 4 here. And then 7, 8, 4, 5, 6. So I have all the questions you have to do circle. So you do those and the answers are there. And so that's your homework. So for the next couple of minutes, I just want to quickly look at that test number 3, which I sent to you. So you should see that in your email. And I'm not going over the test 1B because midterm, because I went over 1A and the working is exactly the same, just the figures different. I write the correct answers somewhere on the sheet if you did it, so you could see where the answer should be, so you could try to see if you could work to get the answers that are there and see where you went wrong. But I'll just go over number 3, test 3. Okay, let me see. All right, so the first one, okay, so we divide by 12, so that should be, oops, sorry. So should that be 2050? And then the next portion, I think everybody got that right. The next one was supposed to be 79.95, because you're going to find 3.9% of the 2,050. They didn't go over the ceiling. So you just multiply the 2,050 by the 3.9%, and you get 79.95. Question number 2, some people still made a few errors with that. 40,000. The first 40,000 is 6%, so it's 40,000 times 0.06, which gives you $2,400. Then the next, from 40,000 to 60,000 is another 20,000. So it's going to be 20,000 times 0.07, which gives you 1,400. And then the last portion, the remaining 12,000, because you already did 40 and 20 is 60. 60 from 180 leaves you with 120,000 times 0.075, 7.5%, and that gives you $9,000. So altogether, that adds up to 12,800. All right, the next one talks about Treasury Bill. So if you're going to do 10,000 times 0.09 times 26 over 52 equals $450. And then you're going to take away the 450 from the 10,000. So 10,000 minus 450 gives you $9,550. And then to work out your effective rate, you're going to put the 450, which is your interest, over your actual amount, your proceeds, 9,550 times the 26 over 52, which works out to 9.42%. Okay, go to the next page. All right, so this one is a oh boy, this should be a simple discount note, sorry. Simple discount note. So the maturity value would be the same as the face value. So it would be 12,000 because the interest is coming out first. So you're not adding to that. The bank discount would be 12,000 times 0.095, 9.5%, times 100 over 360, which gives you $316.67. So the proceeds, would you subtract that from the 12,000 minus 316.67, and that gives you a total of $11,683.33. Effective rate, you put the 316.67 over the 11,683.33 times 100 over 360, and you get 9.76%. Okay, and the last question, the interest and maturity value, you're going to find, okay, that's going to be 2,475 times 0.11 times 88 over 360, which gives you $66.86. and 55 cents. So the maturity value, you have to add that to the 2475 plus the 66.55, which gives you 2541.55. The discount period, 344 minus 278 equals 66. When you do your subtraction there for the days, so you're going to look for the 2 dates, October 5th and December 10th. December 10th would be 344, October 5th would be 278. And then since the length of the note was 88 days, you're going to subtract the 66 from 88. So the bank will hold the note for 22 days. So that's your discount period. So you're going to calculate the interest based on that discount period. So it's going to be 25, the maturity value, 2541.55 times 0.09 times the 22 over 360, which gives $13.98. Okay. And then your proceeds, then you're going to subtract that from the face value. So it can be 2541.55 minus 13.98, which gives you 2527.57 as your final answer for that one. Okay. I think all of you did reasonably well, so I didn't bother to do a makeup for that one. So that should be it for that. Now, our next class, of course, next week would be the 20th. Okay, so we are basically caught up. We finished, okay, stocks, bonds, mutual funds. Your homework is on this presentation, which I'm going to send to you. I have your grade sheet posted, so I hope you check it to make sure whatever I have there is correct. And if you have any queries, let me know. So today I only have 4 students. I see Miss D. Roll, Miss A. Knowles, Miss V. Heald, and Miss B. Bain. Although Miss Bain came in very late, but you were here. So I have 4 students today, so I'm going to mark your attendance on the sheet. And I got homework from, I think, a couple persons. I did say received for those who sent it. So if you don't see me respond, then you need to let me know. But I have been trying to make sure to respond to all those persons who sent in the homework. So if you don't see a response from me, please let me know. So next week we have the last test, quiz type test, which will be based on chapter 12 and 21. But I guess under the circumstance, you'll get it as a sort of assignment to do at home and email back to me. So next week, we'll be looking at mortgage calculations. And then the 4th of December, you have your second midterm, which you'll do at the Institute. And oh boy, we're almost near to the end. Okay. So those persons who need to make up with homework, like I said, you could, whenever you finish, you could send it to me and I'll credit you. And I encourage you to get the practice because it's a lot that we're trying to cover in a short space of time. And then I know you have other courses doing as well. So the practice can be very helpful. And so the more you are able to do, the better you can increase your skill, your proficiency in doing these calculations. Okay, so as much as possible, please try and get all the homework done and submit them so you could be credited. All right, any questions? Any concerns? I didn't get any response. Ms. Roll, you have any
I
questions?
have a
or-
question
Yes. Mhm.
with the homework. I think it was chapter 11 with the promissory notes. I saw where you only had 50%. Is that because the other part 2 should be submitted with the compound interest homework?
Yes, ma'am. That's just what it is. So as soon as you submit that, I'll increase that once I see that portion of it. Have you submitted it yet?
No, not yet.
Okay, so once you submit it, then I'll make the adjustment.
Okay.
Okay. All right. Well, if there are no other questions, I will see you next week, God's willing. And okay, have a good week. Bye-bye.
Okay.
Okay then.